Cession. Cession refers to the transfer of part of an insurance company's obligation to a reinsurer. This allows the ceding company to reduce its exposure so that risk is distributed among two or more companies instead of falling upon a single insurer. Insurance can be ceded in two ways, proportional or non-proportional. Proportional reinsurance is an arrangement where the insurer and reinsurer share a great percentage of both premiums and losses. Non-proportional reinsurance is a system by which the reinsurer pays only when losses exceed an agreed upon amount. How cession works. Insurance companies make money by assuming the risk of certain unlikely events, such as fires, accidents, or floods, in exchange for a premium that is higher than the expected payout. When an insurer assumes new risk, they must ensure that the maximum payout will not bankrupt the insurance company. Cession allows an insurer to reduce their risk by passing on some of them to the reinsurance market, as well as a portion of the profit. In short, the insurer are taking out an insurance policy of their own to protect themselves against the possibility of having to make a large payout. Reinsurance creates an opportunity for insurers and reinsurers to profit at each other's expense, based on actuarial calculation that price the risk incurred. For example, suppose a reinsurer believes the risk of loss on a certain coverage is less than it actually the case. If an insurer has a more accurate risk model, he can recognize that a reinsurer is undercharging for this coverage. In this case, the insurer simply sells the policy to customers at a higher rate and buys reinsurance at a lower rate, locking in arbitrage profit. The global reinsurance market was worth $660 billion in the first half of 2021, according to Statista. Reinsurance. Setting risk to a reinsurer allows an insurance company to reduce its overall risk exposure. Reinsurance can be written by a specialist reinsurance company, such as Lloyd's of London or Swiss Re, by another insurance company, or by an in-house reinsurance department. Some reinsurance can be handled internally, such as with automobile insurance, by diversifying the type of client that are taken on. In other cases, such as liability insurance for a large international business, specialty reinsurance may be used because diversification is not possible. The agreement between the ceding insurance company and the reinsurance company will include comprehensive terms for the cession. The reinsurance contract will outline the purchase condition under which the reinsurance company will pay claims. There are two main types of reinsurance contract, facultative and treaty. In a facultative reinsurance contract, the insurer passes one type of risk to the reinsurer, meaning that each type of risk that is passed to the reinsurer in exchange for a premium has to be negotiated individually. In a treaty reinsurance contract, the ceding company and the accepting company agree on a broad set of insurance transactions that will be covered by reinsurance. For example, the ceding insurance company may cede all risk for flood damage, and the accepting company may accept all risk for flood damage in a particular geographic area, such as a floodplain. Benefit of cession. Cession allows insurers to provide coverage against events that they would otherwise be unable to handle due to the possible size of the payout. If a certain type of accident has an extremely low probability but an extremely high payout, a single insurance company might not be able to underwrite a policy, even at a relatively high premium. Reinsurance allows insurers to provide coverage by passing on some of the risk to another insurer, as well as a share of the premium. This works to the benefit of all involved. Both the insurer and the reinsurer can expect a net profit, while the insured is able to retrieve the coverage they need to do business. Example of cession. An interesting example of cession appears in nuclear insurance pools, which provide coverage for nuclear power plants. In the United States, plant operators pay annual premium of more than $1 million per reactor. Although accidents are extremely rare, a single serious event could cost billions of dollars in liability, much more than a single insurer could handle. As a result, many countries have no clear insurance pools that provide coverage against such an eventuality, diffusing risk among many plans operators. Thank you.